Ever pondered how the ebb and flow of the world's economy can sculpt your investment landscape? Imagine a world where your financial decisions are guided not by mere speculation, but by the rhythmic cadence of economic cycles. Intriguing, isn't it? This idea isn't as far-fetched as you might think. Today, we're diving into the fascinating interplay between economic cycles and investment opportunities. A world of insights awaits. Understanding economic cycles can be the key to unlocking the door to successful investments. In order to navigate the investment world effectively, we first need to grasp what economic cycles are. These cycles, also known as business cycles, are the natural rise and fall of economic growth that occurs over time. They are a fundamental part of macroeconomics and are driven by many factors, including government policy, business investment decisions, and consumer behavior. The economic cycle is divided into four primary phases: expansion, peak, contraction, and trough. Let's take a closer look at each phase. The expansion phase is characterized by an increase in various economic indicators such as employment, income, production, and sales. During this phase, businesses start to see an increase in demand for their products and services, leading to higher profits and employment rates. Next comes the peak. This is the high point of the cycle where the economy has reached its maximum output. It's a phase of prosperity, but it also signals that a contraction or a slowdown in the economy is around the corner. The contraction phase follows the peak. This is when those economic indicators we mentioned earlier start to decrease. Businesses may see a decline in demand and unemployment rates may rise as companies try to cut costs. Finally, we reach the trough, or the low point in the cycle. It's not the best of times, but it does mean that an expansion is on its way and things will start to pick up again. Each of these phases impacts different sectors of the economy in different ways. For instance, during an expansion, sectors such as technology, consumer discretionary, and industrials tend to do well. On the other hand, during a contraction, more defensive sectors like utilities, healthcare, and consumer staples usually hold up better. Now that you have a basic understanding of economic cycles, we can delve into how they affect investment opportunities. With the knowledge of economic cycles, we can now explore how they shape investment opportunities. Let's delve into the complex world of economic cycles and see how they influence various investment avenues. You see, economic cycles are not just abstract concepts, they have tangible impacts on businesses, industries, and ultimately the investment opportunities available to us. To understand this better, let's consider the four stages of an economic cycle: expansion, peak, contraction, and trough. Each stage presents a unique set of investment opportunities. During the expansion phase, the economy is growing, businesses are thriving, unemployment is low, and consumer confidence is high. This is often a favorable time for investing in stocks and real estate. In a growing economy, businesses tend to generate higher profits, which can boost stock prices. Similarly, real estate values often rise as demand for property increases. Now let's consider the peak of the economic cycle. This is when the economy is at its highest point and is about to enter a downturn. While this phase can be tricky for investors, it can also present opportunities. For instance, this could be an ideal time to invest in commodities, as inflation often rises during this phase, increasing commodity prices. Next comes the contraction phase. This is when economic growth slows down and might even start to decline. During this phase, it can be beneficial to invest in bonds and safe haven assets. The reason being, as economic uncertainty increases, investors often seek the safety of bonds and other low-risk investments. Finally, we have the trough, or the bottom of the cycle. This is when the economy is in a slump, but remember, even in a downturn, there are investment opportunities. This could be a good time to invest in undervalued stocks or distressed assets, as these may offer high returns when the economy starts to recover. Investing wisely means understanding these cycles and adapting your strategy accordingly. So keep an eye on the economic cycle and let it guide your investment decisions. It's all about being flexible and staying ahead of the game. So what have we learned from our exploration of economic cycles and investment opportunities? Economic cycles, with their phases of expansion and contraction, significantly impact our economy. These cycles can create windows of opportunity for savvy investors who understand the rhythm of these fluctuations. By leveraging this knowledge, you can identify potential investment opportunities and navigate the financial seas with added confidence. Remember, the more you understand about economic cycles, the better equipped you will be to make informed investment decisions. The world of investing awaits you.